Good afternoon, I'm Brigid Taylor and this is Currency Wars. Welcome to our new live slot just before power lunch. And let's prepare the strategy for the week ahead. Right, the big data released last week was the US non-farm payrolls, which disappointed, coming in at 214,000 versus the 235,000 that was expected by the market. The unemployment, however, improved to 5.8% from 5.9%. But the market reaction was somewhat mixed, with the US bonds strengthening and equities moving sideways initially. This week we saw the South African manufacturing production beating expectations at 8% year on year. However, this data comes off a very low base, and if we look closer at the data, when viewed on a seasonally adjusted 3-month basis, the outpack in fact contracted 1.3%. The manufacturing sector accounts for 15% of GDP, and as such, this places further pressure on a fragile growth outlook domestically. The local retail sales came in well below expectations at 2.3%, and this highlights the weak consumer confidence and disposable income that's under pressure. Meanwhile, in the UK, the inflation deteriorated further, supporting views that the expectations for any form of rate hikes from the US, the UK, and the Eurozone are some way off. Meanwhile, the South African rand was supported as a result of dollar weakness, commodity prices rallying, and interest rates looking to remain near zero in the G7. Foreign inflows were seen into our equity markets and more aggressively into the South African bond markets. In the week ahead, we'll be watching commodity prices and monetary policy commentary for further direction. Right, let's have a look at the strategy and how the week played out. Last week we saw both Andre Ehrenstein and Andre Cilliers looking for the rand to remain above that 10.90 and trade as high as 11.25. They were correct on the bias, however not negative enough on the momentum. And as we can see by the graph, we did in fact trade a high of 11.28 before the rand regained some strength and is trading back around that technical 11.18 level. So let's have a look at the lay of the land, and my guest host today is John Cairns. Welcome, John, and thanks so much for joining us live on the show. We have had quite an interesting week. Obviously, we've had all that data. Now we've got absolutely nothing. So it's about digesting that data and looking what it really means in terms of where the market's moving. We saw that initial deterioration of the rand. It also did come on the back of those downgrades that we saw with regards to both our local sovereign rating as well as the bank ratings. So what is your picture at the moment with regards to the local fundamentals and how much impact they're having with regards to what we're seeing globally?
I think local fundamentals are having almost no impact. You're certainly right that the rating downgrade did impact on the rand, push the rand weaker. But if you look at dollar rand over the past week and you just overlay it on euro dollar, it's practically the same chart. Essentially, it's all about the denominator. It's all about what's happening in the dollar. Can that great dollar rally of 2014 get going again?
Yeah, and that's a big question. I mean, if we look at, this momentum that's driven the market volatility has really been around views or speculation around interest rates potentially being hiked in the United States, and then obviously looking at the UK economy starting to show signs of a little bit of growth and moving in the right direction. But more and more as these datas are, if we look at them in a more granular fashion, we start to realize that we may be a little bit over-ambitious, especially if we look at the global picture. We look at China, we look on the knock-on effects in terms of emerging markets. So if we're looking at purely where we can possibly see some form of momentum or volatility, does it remain purely around interest rates in your view, or are there other issues that we need to keep in mind?
Yeah, no, I think it is still, I mean, the big story is still interest rates and when is the Fed going to hike. And I mean, just to contrast it, so you talk about the UK. Yes, the economy was growing very fast, a bit more fragile now, so rate hikes pushed out. ECB last week, hints of quantitative easing, maybe that's going to come through in December. Bank of Japan, more easing from them. China, potentially more stimulus. So you've got a real contrast between a Fed that's looking to hike because of strong growth and the rest of the world. And of course,
but Yellen has said, I mean, even as you say, I mean, the data has been great and people have been speculating around these interest rate hikes. However, when Janet Yellen does get up to talk, she does talk about the fact that the US economy is starting to pick up, but they're concerned about those knock-on effects from the weaker global growth scenario and what that impact could in fact be on this trajectory of growth growth that we're seeing in the United States?
No, perhaps not, Brigid. Yellen, at the last FOMC, it was very interesting. The Fed statement made no mention of the weakness in the rest of the world. I think what's really concerning the Fed is the labour participation rate. So as we all know, the unemployment rate has dropped down, as you said, to 5.8%. The problem is there's still a lot of discouraged workers out there. So the Fed's having a very tough time trying to decide how much slack is still in the labour market. Usually if we'd get to an unemployment rate of 5.8%, the Fed would still be hiking. So in my mind, it's still very unclear when the Fed is going to hike. The market pricing has swung all over the place. Some stage, they'd even pushed that out to January next year. We're probably in about August, so it's not January next year, January 2016. Now, at present, talking about August 2015. That is still the big story, and the main way it's impacting us at the moment is through euro-dollar. But of course, the bigger underlying question is whether we can still attract inflows when the Fed is hiking.
That's the key, and I think that we've got a conundrum because we've got weak fundamentals in South Africa, which we all know about when we talk about imbalances, we talk about the growth trajectory, we look at our sovereign rating being downgraded, all these issues sitting at the back of our minds because we're going to have a budget in February again. Is the government and the National Treasury able to deliver what's been promised or what's been put on the table? And that's going to be a question for February. However, at the moment, the market completely negates all of that and still continues to look for value proposition regarding interest rate carry. So in South Africa, despite all of that, we continue to see these foreign inflows. You know, what is your feeling around the market becoming very complacent with regards to just assuming that that's a story that will continue inevitably?
Yeah, no, I think that's exactly it. I mean, what you all got to get our heads around is, has the market priced that Fed hike? So when we get to that moment, is it just, as with the end of tapering, the market didn't even blink? I mean, you had no reaction at all from that. Or is it another tantrum? Remember the tantrums?
But they talked about managing expectations, and I think monetary policy is they realize that making commentary or managing expectations is about keeping volatility at a minimum in the markets, where the market at the moment is very uncertain. The concern for me, though, is that we know that there's these weak fundamentals that underlie all of this. There's things that have been put in place, but we've seen that they just prove to be band-aids. However, the market continues to operate in an environment where it's just about cash looking for a home. It doesn't really speak to investment like you do in a company where there's a long-term sustainable growth curve and that looks like a good investment. You're doing it purely out of a short-term gain. So that's the big risk I think that we face in South Africa. So if we look at the South African consumer, we look at South African business, we've got mining production, we've just seen retail sales. From a fundamental perspective, if we look at the South African fundamentals, from your view, what are keys that we need to watch as South Africans in this domestic economy?
So I mean, your introduction alluded to the pickup in some of the data points, particularly the manufacturing. We have reached a low in our view at Rand Merchant Bank in terms of the growth outlook. We can look for accelerated growth in the next few quarters.
But it's off a low base, right?
It's off a low base, and it's not going back to 3% levels anytime soon. So maybe going back to the mid-twos next year. So the economy is turning around. So the news flow is certainly going to be better. But just extracting from that for a moment, yes, we all acknowledge there's weak fundamentals, but there's got to be a level of the rand that's weak enough to adjust to compensate for those for those negatives. And we've had 2.5 years of a sliding rand. Perhaps we're there. If you look at the export figures, volumes are picking up nicely. Import growth is constrained because of the weakness in the rand. It shows that the economy is adjusting, getting that benefit from the rand.
So it's starting to get some rebalancing again. The bigger concern, though, is if I look at Chinese data and we look at the import data from China, that's also slacking off slightly. So it does cause us to be concerned about the fact that, yes, in South Africa, yes, the weaker rand potentially has created behaviours in terms of how we purchase and how we more cognizant about that because of the cost attached to it. However, when we look at the export sector, which is effectively going to be the driver to get us back into better current account deficits, help us readjust the imbalancing, etc. If we don't have demand from offshore, how do we think that that's going to impact us in terms of the longer term trajectory?
Yeah, so so you're perfectly right. The demand for what we're exporting is growing very, very slowly. In some areas like iron ore, it's potentially even falling. So that is definitely a constraint. Our two biggest export markets, China, Europe, both areas are under a bit of pressure. I mean, the growth area in the world is the US, but we don't export to them. We hardly export anything at all
Well, this is the concern, and I mean, we've also got, if we look at the sectors that we find ourselves in, is productivity something for business that makes sense in terms of seeing, if we look at operating expenses across all the numbers that have recently been released out of the JSE with regards to earnings, a lot of pressure being placed on operating expenses, and these are issues that potentially will start to impact the market. So let's look back at the rand, let's look at where we're going with regards to all of this noise, and let's just simplify it for the viewers. So we've got foreigners that are still looking at South Africa as an investment portal because of the carry trade. Fundamentals aside, we know what they look like. Just give us a quick view in terms of the week ahead. What do you think are going to be the key drivers?
So I think it's quite simple. If you're trading on the Euro cross, we're very happy at 14. No reason to think we're going to diverge much from that. If we're looking at the dollar rand cross, we've got to worry about the dollar and not the value of the rand, because the rand's quite constant. The dollar is being flung around by the data. The important data in the coming week is definitely tomorrow's Eurozone GDP figures. Yep. Weakness in Europe implies stronger dollar, implies a rand weaker against the dollar. Dollar rand, we've been up into the high 1130s 3 times this year. That provides very strong resistance.
Okay, so just to look for the week ahead, we're going to be looking for GDP data. What is your view quickly around the commodity price? Is that going to be a swinger, do you think, in terms of us being an emerging market that's on the back of a large commodity base?
Yeah, so it's a difficult question to answer because oil's falling faster than the export prices, the prices of the commodities that we export. So we could actually be gaining a little bit from the fall in the commodity prices for now, but it's quite difficult to analyze.
Okay. All right, so now we're going to have a look at where we stand. So we've got a good view from John in terms of the real risks and opportunities, but now I'm going to put you on the block. So I'm going to ask you to give us ranges for the week. Let's look for our investors in terms of what the bottoms are that you're expecting from a technical perspective, where we can expect the trajectory on the rand, and if you're comfortable to also talk about the euro rand.
Okay, so euro rand is easy, just 14. We're not going to move much more than 10 cents either way of that 14 level, I don't think. Dollar rand, again, it's all about euro dollar. The resistance levels are clear up in the high 1130s, a band from 1135 till 1140. No real strong support, but maybe the bottom for the week ahead, maybe 1105, 1110.
Okay, great stuff. So thank you so much for your view. I appreciate it. And in conclusion, look for rand to remain relatively range bound as we absorb all the data that's been released. We're looking for euro to continue around that 14 level and the rand to potentially trade between sort of 1105, 1110 and potentially as high as 1130. You're welcome to send me your questions or comments to @CNBC Africa, #CurrencyWars410, or myself personally at Brigid R. Taylor for your personal responses to the FX markets. Until next week, good luck in the trenches.